there's hard to have bubble behavior when people aren't irrationally exuberant and overly optimistic about the future, about stocks, about kind of this trend that's going on in the market. Everyone is so aware that an AI bubble is possible, it makes it harder to happen. Welcome back to another episode of Off the Wall. And today I'm flying solo, just Nate Tonsager, and I'm here for one reason and one reason only. Last video, we talked a lot about the AI bubble and how I don't think it's a bubble, and I still don't think it's a bubble. But that generated quite a few comments from the last video. So I wanted to hop on, show some charts, really give you the data behind why, again, what I'm seeing and why I believe that we're not in the biggest bubble that you've ever imagined, or a bubble like the tech bubble of the 2000s. And I think if you're a listener, if you're an investor, if you're listening to either also financial media, the mainstream, you're seeing headlines like this. You're seeing headlines on the bottom of the TV screen that are meant to grab your attention, meant to incite an emotion, hopefully, again, to keep you tuned in to hear more. And they're saying things like, will the AI boom trigger the next crash? Fox Business has recently had investors worry over AI bubble. CNBC also, AI spending reality check. Right now, just everyone has seemed to be talking about why AI is a bubble and is getting ahead, and there's a giant market crash coming. Now, I can't predict that. I don't believe there's a crash coming for a lot of reasons, but you keep hearing these constant themes. So what I tried to do is identify three big themes that I'm hearing. And I really wanted to dive into some of the data that they may not be showing you when they're showing these headlines. A lot of the time, you just get the headlines. You don't see the charts, the data, the things behind it that maybe give you a bigger picture of what's going on. Because when it comes to financial markets, no one data point is perfect. It takes an entire Mosaic approach of putting all the data points together, looking at various measures to really see what is the overall picture, the overall theme. I think, again, the main theme that I keep hearing from people around why is AI in a bubble is strictly that the only stocks doing well right now are AI and technology stocks. And that's really not the case anymore, especially over the past recent quarters where we've looked at some of the earnings reports from other companies. So looking at a few charts, I think a great one to start with here is there are 11 sectors that make up the S&P 500. And if you want to see which sectors have positive momentum or in a positive trend, you can look at it over both the short-term and long-term stance. Well, let's start with the short term. Right now, 7 of the 11 sectors have more stocks above their short-term average than tech. Well, and how do you measure that short-term average? Well, you can do it by looking at what's called the 50-day moving average. So taking a stock's previous 50-day prices, averaging them out, and seeing is the current price above or below that. If the stock's current price is above the 50-day, that's usually seen as a positive trend signal. If it's below that 50-day average, it's seen as a negative. Well, right now, just looking at the S&P 500, almost 57%, so over half of the stocks are above their short-term averages. But more importantly, it's not just tech stocks. If you look at kind of the second line on the chart there, infotech actually has below that. Only about 46% are above their short-term averages. But if you look at the other sectors like, communications, financials, materials, energy, healthcare, consumer staples, all of those are not AI really related themes. Sure, they might have some AI exposure through various secondary effects, but it's not just tech stocks and AI stocks that are seeing short-term strength. It's across the entire board. I think it's incredible to see the healthcare sector have almost 80% of their stocks above the short-term averages. Consumer staples are at 73.5% of the stocks above their short-term averages. And those are defensive sectors. Those aren't risk-on sectors. So you're seeing a broad-based swath of companies that are outside of tech really showing short-term strength when you look, again, that 50-day moving average. But the markets aren't just short-term. So what does that mean for the long term? What can we look at a long-term price trend metric? The answer is yes. You can expand that out to look at what's called the 200-day moving average. So same math, except now you're extending the look-back period from 50 days to 200. The number of sectors that are beating tech over the long term does come down. But again, remember, there's 11 sectors. 5 of them have stronger long-term averages than tech. And the market itself, the top line of the chart, 70% of stocks on the S&P 500 are above their long-term average. You're seeing strength from a technical side of the market, both on short-term and long-term measures, and it's not isolated to tech. If you look at it, some of the sectors that have the most amount of stocks above their long-term averages, financials, materials, energy, healthcare, and real estate. Those are not all pure AI plays, meaning that, AI is the only thing doing well in this market. We've really seen a broadening out of the market strength, which is a very healthy thing. Again, not just over the short term, but over the long-term averages as well. You want to see stocks above their 50-day moving average, above their 200-day moving average, to feel like you have strength and a broad-based strength. I think what would concern me and what would make those headlines that I showed right at the start of the video here is really focusing in if tech was the only sector that was doing better over these measures against the market. But really, again, it's broad-based strength. Strength is not limited just to the tech sector. Now, I can already hear some people saying, well, just because, things are doing well, there might be doing well because people are being maybe a bit overzealous about these kind of investments. But I'm here to kind of show you in the next chart is that the stocks are doing well because earnings are there to support it. A big thing you want to look at, and we just went through, another quarterly earnings release, we're wrapping it up here on August 25th when I'm recording, 77% of companies are beating the earnings estimates that analysts are putting out. And that's right near the historical average. The average over the 10-year period is roughly 76%. Again, of all the stocks, 77% are beating analyst earnings estimates. And it's not just tech. Sure, tech has the highest beat rate at about 85%, but industrials has an 81% beat rate, healthcare at 79%, real estate at 78%. So again, three sectors that aren't really tied to the AI boom are beating their earnings, or the percentage of stocks beating earnings is above the long-term averages. Then there's a huge chunk in the middle that are a little bit below the long-term averages, but not significantly. Look at consumer discretionary stocks, consumer staple stocks, financials, utilities, all in that about 73 to 73.5% beat rate. So again, 76 is the average. Of looking at all those stock or all the sectors, 4 are a little bit below, 4 are better. And you're seeing a few outliers there when it comes to, communications and energies are seeing lower beat rates than the broad market historically. But majority of the market is beating earnings at a rate that is, again, right in line with average. And that's what you want. You want to see companies beating their estimates when it comes to kind of the quarterly earnings. Not, underperforming what people expect, because that's when you can get negative surprises in a market. If companies aren't beating their earnings, meaning they aren't achieving what the market expects, what analysts expect, then you can see price declines, and significant ones at that. The largest price drops that I've seen in my career come from when a company misses earnings. And when that happens, again, it shows that the market is more optimistic, or consensus is more optimistic than what's really happening. That's where you can get the dislocations of a bubble effect. So right now, we're not seeing that. Right now, we're seeing companies have the earnings and beating earnings right in line with what we've seen year over year over year. It's not like it's a bubble in that way. And I think what's more important, or maybe equally important to earnings, is what is the guidance that these companies are giving for the future? Not what have you done over the past quarter, the past, fiscal year. What are you expecting going forward? And the news is just as positive on that front, in my mind. Many sectors, as you see in the chart here, are raising their earnings guidance. So for the video watchers, and I encourage everyone to watch this one on videos, because again, I got a lot of data, a lot of charts in this one. But if you look at it, if you look at all the stocks this earnings season, about 15% of them are raising their guidance. Meaning what they thought that they were going to be able to earn earlier in the year, they're now increasing that amount. So with all the uncertainty coming off the tariff tantrum in 2025, escalating trade wars, and then an actual war in the Middle East, companies are now becoming more optimistic. And CEOs aren't doing this, or companies aren't doing this for no reason. Again, they want to make sure they can beat those earnings estimates for the future. If they're guiding towards higher numbers in the future, they need to be pretty confident that they're going to beat them. Otherwise, if in the future they don't meet those new guidance expectations, now their stock price gets crushed and has the ability to drop significantly. And what you see is it's not just that all stocks are raising earnings at a 15% rate in the most recent earnings season. That's significantly above the last 25-year average and the last 10-year average. And if you look at it, again, the story is not just an AI technology story. You're seeing healthcare, real estate, industrials, materials, financials, all raising their guidance at a much faster and higher rate than they have in the past 10 and 25 years. And if you're looking at the chart, you'll see it's significant. There's only 2 sectors of the 11 where the guidance raises this past season are lower than the historical expectations. And you see it, and when you look at it, it's utilities, it's communication services. And remember the chart I showed earlier about which sectors have the least amount of stocks above their, short-term and long-term averages. It was those 2 sectors. So again, a large part of the market is doing really well, not only from a technical standpoint of being above short-term and long-term technical measures, but also they're doing it because there's earnings to support it. It's not just that they're beating earnings, but they're raising the guidance for the future, saying the future is going to look better than what we had thought it was previously. And it's not limited to tech. We need to remember that when you look at the data. It's easy to say, well, only AI and technology stocks are doing well because some of the best performing industries this year are semiconductors. Semiconductors is one of those big industries that everyone hears about and has seen a lot of growth in. But if you crack open the hood and look at what are the sectors doing in the S&P 500, it's not just a tech story. It's not just a semiconductor story. There are sectors that are doing well and doing well because they are earning money through their current earnings, but also project to earn more money in the future. Now, on to the second big kind of talking point that I hear when I listen to financial media in the traditional sense, and I see those tickers at the bottom that preach doom and gloom to get, I think, listeners to tune in. Stock markets are overvalued and expensive. Okay. There's a lot of ways we can measure valuation. I think I've talked about this before, but it's a really important point, so I need to reiterate. You can value the valuations of the companies inside the S&P 500 various ways. One of the simplest, most straightforward, well-known ways to measure the valuation of a company is looking at what's called its price to earnings ratio, its PE ratio. Essentially, what that is trying to show you is what is the price you're paying for $1 of a company's earnings. And you can use it across a variety of companies, variety of industries. It's just a really good way of seeing how expensive is it for me to buy $1 of a company's earnings. The higher your PE ratio, the more expensive it is when it comes to buying the earnings of that company. Traditionally, people like to see low PE ratios. They think they're buying at a discount, and they could be. The price of the stock could recover. The stock could be, down for whatever reason. However, what we want to look at is always, what does the market look like when we're talking about our stock markets overvalued and expensive? Right now, the PE ratio, looking at the forward earnings of the S&P 500, is about 20. The 10-year average is 19. So you are overvalued by that metric. And again, it's by a small amount. You're not wildly overvalued. The current PE, looking again at forward earnings, is not 40, 60, or anything crazy like you've seen at some of the previous peaks and bubbles. You are a little bit expensive, though, when you look at just purely the PE ratio. Now, what people are missing is that PE ratio justified by the earnings growth? Because if a company is growing earnings at a very high rate, and it's a premium earnings growing kind of company, I should pay more for it. The PE ratio should be higher on a company that has very strong earnings growth. So it's not just about the PE ratio, the price you're paying. It's the price you're paying, but also what are the earnings growth that you're paying for as well. So not just paying for $1 of earnings, but paying for earnings growth. If you look at the chart on the screen, you'll see based on 2026 growth rates, which are around 30% earnings growth, a very strong year for earnings growth. The PE to growth ratio, what they call the PEG ratio, is about 0.67. Looking at, the longer term averages, you'll see the 10-year average approaching 1.6. The 20-year average over 1.2, and the 30-year average is about 1.2. So what you're seeing is the market is not really that expensive when you factor in the growth rate of the earnings. Sure, at headline value, it might look expensive, but again, if a company has fast growing earnings and quality growing earnings, you should pay more for it. The PE ratio should be higher. So that's what you always have to relate it to, and that's why I really like that PEG ratio, the price to earnings to growth ratio. Now, a big theme I think I'm hearing too from people is, well, earnings in 2026, again, at 30%, we can't replicate that year over year. Okay, well, if you look at FactSet, which is a good resource for looking at kind of earnings estimates, market data, you'll notice that they project earnings to fall noticeably by probably double digits in 2027. So earnings are going to come down. So if earnings are going to come down, let's assume the price of the market or stocks doesn't move a whole lot, but earnings come way down. That's where you're going to see that 2027 growth line move significantly higher towards, about a 1.5, much closer to that 10-year average, but still not above it. So even if earnings come down significantly next year and the AI bubble doesn't continue this fast-growing earnings track of, 30% a year or year over year over year, the valuations that we're seeing today are still within historical averages and in line with those kind of metrics on the PEG ratio using those lower earnings. So I think this is a good way to always look at it. Remember, it's not just looking at the headline number of what are you paying for the earnings, but are you buying something that's quality as well? Because it's kind of like for me personally, I always like to buy certain products that are the premium brands because I know they're going to last and I know they're going to give me good quality. This isn't a plug, they're not a sponsor, but Yeti is always something I have always appreciated paying a premium price for because I know the quality of the product supports that higher price. Has same things happening in the market right now. This isn't the tech bubble of the 2000s where you could just put .com after your name, generate no revenue, be what's called pre-revenue, and get wild stock valuations and see wild appreciation. There probably are some companies like that out there, but right now, when you look at the S&P 500 again, those valuations that I mentioned that might be a little bit higher than average on the headline value are being supported by the earnings growth. And we just showed that in the past couple charts. It's not just tech companies that are beating their earnings and raising guidance. It's stocks in various sectors, in various industries that are seeing very strong earnings reports. I think that's what's been driving, again, the market growth and why we're seeing so many stocks that continue to move higher in the face of a lot of volatility outside of the markets on the geopolitical landscape, or even from people pontificating about, is AI going to really pay off in the end? Is all this money that these companies are investing going to be useful in the future? Well, right now they're generating a lot of cash flow, a lot of earnings, and they're not becoming wildly overvalued while doing it. I think the last factor that everyone always says is very important to bubble behavior is being overly optimistic. So I'm continually hearing investors and CEOs are being overly optimistic about AI stocks. These guidances that I mentioned earlier on, they're all supported by people, just being too optimistic and not a realistic person. That's impossible to know. It's impossible to predict what's going to happen and how much return on investment all this AI spending and CapEx spending is going to have. But CEOs and investors aren't making decisions that they're not confident in. They don't want to go bankrupt. They don't want to have to be out over these skis. They want to continue to grow, but do it in a reasonable way. And that's where I think it's important to look at the sentiment measures of, we'll start with investors, but then CEOs. So let's start with investors. Right now there's a data series out there from the American Association of Individual Investors, AAII, that looks at the difference between the amount of investors that are calling themselves bullish versus the ones that are calling themselves bearish, and takes the difference. The bull-bear spread is what they call it. If that bull-bear spread is positive, that means there's more bulls out there than bears, more people that are optimistic in the stock market than are pessimistic in the stock market. Right now, that measure is actually negative 4%. That means there's more bears out there than bulls based on the investor sentiment. And that's really good. That doesn't mean that people are predicting the end of times or are truly fearful. I mean, if you look at the chart, you'll see in 2025 during the tariff tantrum, the amount of bulls, was approaching 50%. It's good that investors are being bearish, because if you look at it, they are being bearish, but they're being reasonably bearish. They're not predicting the end of times when it comes to, a reading of negative 4% on this bull bear spread, because what you see in 2025 during the tariff tantrum, that number was approaching 50%, meaning there were 50% more bears than bulls. That was true fear. And that's when you saw the markets going down 20%. Right now, what you're seeing are investors are being cautious. They're not wildly bullish about the market, but they're not wildly bearish. But having more bears than bulls gives the market something what's called the wall of worry. And you always want to have that, because the market seems to always climb that wall of worry. When you have people that are worried, that are being cautious, it really can be a good thing for the markets, because that means it's not getting overly optimistic. That's when you get into bubble behavior, is when you see a wildly high number of bullish people over bearish people. Not the case today when you're looking at the data. And that's a good thing. But that's another thing you're not hearing. You're hearing a lot of people come on TV and predict doom and gloom, but a lot of people aren't talking about, while that is actually probably a little bit of a good thing, because it's keeping people away from inflating that bubble. If, this metric was showing extreme bullishness, and we were seeing all this AI growth and AI fever of, fear of missing out, then we could actually see, a bubble-like behavior. But that's pretty hard. I think it's very hard to have a bubble when you have people that are more bearish than bullish. Now, that was investors. Now, what about CEOs? Because again, CEOs are really the people that are driving these kind of decisions when it comes to making long-term investments, doing large capital expenditures, building the plants that really kind of drive economic growth and filters down and trickles down. Well, last quarter, CEO confidence is back into positive territory. They look at CEO confidence and try and see, are you more confident about the future? Are you less confident about the future? And really try and get that break even of 50. Are there more CEOs that are optimistic than are pessimist? In 2025, again, you'll see there was large negative CEO confidence. There were a lot of CEOs who were very, very pessimistic when the tariff tantrums and the initial trade wars came out on Liberation Day a year ago. Well, right now, what you're seeing in most of 2026 is you've had CEO confidence and not getting to heights or even the lows that you've seen in previous bubbles. They're hovering right around the middle, right around that 50 mark. And that's, again, a really good thing. Being cautiously optimistic from a CEO means they have optimism and growth for the future, so they'll continue investing in the economy. But they're not just piling in with no regard to what the risks are in the market or in the global landscape. Cautious optimism is a very healthy thing for the market. I think you're seeing that on CEOs. And again, I think you're seeing it with investors. With the bull-bear spread, that is just a little bit negative. If it was a little bit positive, I'd be saying the same thing. There's hard to have bubble behavior when people aren't irrationally exuberant and overly optimistic about the future, about stocks, about kind of this trend that's going on in the market. Everyone is so aware that an AI bubble is possible, it makes it harder to happen. Now, I threw a lot of data out here, and data is always something I think you need to look at through the Mosaic lens. There are data points out there that show or maybe kind of try and describe how this could be a bubble. And some of them I completely respect. I'm tracking, I'm watching. But the majority of the data that I'm seeing, which we went through again on the podcast here, it's talking about how, again, there's a lot of metrics that show, first off, the growth in the stock market is not being limited to AI and technology companies. It is broad spread and in sectors that really aren't impacted by AI technology. The market is not wildly overvalued. when you look at the earnings growth that's supporting these valuations. It's paying more for high growth right now. And even if growth comes down in 2027 by double digits, like I mentioned, we're still right in line when you look at that PEG ratio, price to earnings to growth, with the historical averages. And finally, the investors and CEOs are so aware of the bubble, like I just said, it's going to be hard for them to overinflate it because they're being cautiously optimistic. And in some cases, like investors, even a little bit bearish about the future. Now, all this data could change. And that's where Monument's data-driven approach is so important to me. Right now, I continue to say there is no bubble in the markets. There's very little what I'm seeing that supports strong bubble behavior that offsets a lot of the data that I'm looking at and shared today. It is a mosaic, meaning if the pieces that I'm looking at change significantly, I'm going to change my opinion. And I'm probably going to look at our investment strategies here at Monument and rely on the data to tell me, okay, do we need to be reallocating away from certain parts of the market that are more exposed to bubble behavior? And that's where it always comes back to what we talk about being momentum and relative strength investors. It's not blindly sticking to your allocation, but it's having a data-driven plan to know when and where you should be rebalancing to. And right now, what we're seeing through a lot of the data is, again, there's not the apocalypse coming. I could change my opinion next month if a lot of these metrics change. If CEO confidence all of a sudden goes significantly lower. If we're seeing earnings next earnings season come significantly down, more than the drop that we're expecting, that FactSet is expecting in 2027. So it's about listening to the data and having a plan. And if you don't have a plan, now is a great time to do it. Because markets are near their all-time highs. The data is still showing support for a lot of what the current market environment is. But you need to be ready. And I think plan A is always going to be having that investment strategy that can navigate the market swings. But plan almost 1B is making sure you have the cash you need. Because the cash that you need is going to make surviving a AI bubble, if it happens, way easier. So set aside 12 to 24 months of cash. We always say 12 to 18. If you need more, that's a personal decision. But set aside the cash you think you're going to need. So if the market does go into bubble-like behavior and you get back into those headlines that you're seeing on the financial media about the bubble bursting and causing the next market crash, having the cash you need to spend allows you to keep your portfolio invested, ride out that volatility, and participate in the eventual recovery. Because that's the piece of data I think a lot of people also underestimate is the longer your holding period in your investments, the higher the probability you have of having a positive return over that time frame. It's about having time in the market, not timing the market. And that's where the data-driven approach and really using that mosaic look at the data is so important. No one data point is perfect. Data can always be used to bolster someone's point. I tried to show you today that it's not just one data point that I'm relying on. It's the whole picture that we're looking at on why the AI bubble isn't looking a lot like a bubble right now. Well, that's all I had for today. I really appreciate everyone kind of tuning in. You know, we're always grateful when we get kind of engagement on an episode that allows us to talk more about a topic. So, you know, reminder that we always do our Ask Monument Anything, our AMA episodes. And if you want your question answered, all you have to do is leave a comment on any one of our channels, or you can email us directly at offthewall@monumentwm.com. As always, thanks for tuning in. Make sure to hit the subscribe or follow button so you never miss an episode. We'll see you next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, where discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.